Most bad business decisions don't come from bad strategy. They come from business psychology. The meeting lasted 11 minutes. The founder had the numbers in front of her. $340,000 spent, $12,000 returned, 18 months of losses. Every analyst in the room said the same thing: shut it down. She didn't. We've invested too much to stop now. That sentence cost her company $460,000 more. Not because the data was unclear, not because the team was wrong, because the decision had already been made before anyone walked into that room. This is not a market problem. This is a business decision-making problem, and it is quietly destroying businesses that should have survived. In corporate finance, we didn't just analyze the numbers, we analyzed the decisions behind the numbers. There is a name for this in behavioral finance: cognitive bias risk. The boardroom tracks it. Your accountant doesn't teach it. And if you are building a business, or planning to leave your job to start one, this gap is the one that will cost you most. That gap is what this video closes. Here is what the data shows. In a 2019 McKinsey study of over 1,000 business decisions across multiple industries, cognitive bias was the primary driver of strategic errors in 53% of cases. Not bad markets, not poor execution, not undercapitalization, the wrong thinking that happened before the decision was made. Here is the problem. You're not making decisions in a boardroom with a risk management framework and a devil's advocate protocol. You're making decisions alone, at 11 p.m., after a 14-hour day, under financial pressure. That environment does not just create stress, it amplifies cognitive bias. Every psychological trap that behavioral economists have documented becomes 3 times more powerful when the decision maker is sleep-deprived, financially anxious, and personally attached to the outcome. In corporate environments, they account for this. They build what is called a decision architecture, structured frameworks designed specifically to reduce the probability that the human brain will sabotage a sound financial decision. Small business owners have none of this. Employed dreamers, building toward their exit, have none of this. They make decisions through the same cognitive architecture designed to help humans avoid predators 200,000 years ago. That architecture is not built for DSO management. It is not built for contribution margin analysis. And it is not built for evaluating whether to keep an underperforming product line alive or shut it down before it drains the cash reserve. Your brain is not your enemy, but it is not your CFO either. The businesses that survive learn to tell the difference. What follows are the 5 most financially destructive psychological traps in business, through the lens of what they actually cost, and then the exact framework the corporate world built to neutralize them. The first trap has a name. The corporate world has known about it since 1976. Small business owners are still paying for not knowing it. Trap 1. Sunk cost fallacy. In 1976, economists Arkes and Bloomer published the foundational paper on sunk cost behavior. The finding: humans consistently allow past investments, time, money, effort, to distort future decisions, even when the rational calculation was clear, even when every forward-looking metric said, stop. The brain frames cutting a loss as a failure, so it keeps going. In business, this looks like this. A product line that generated $48,000 in revenue last year, but costs $71,000 to run, gets funded for another 12 months because the founder already spent $190,000 developing it. The $190,000 is gone. It does not matter which direction the next decision goes, but the brain does not process it that way. The brain says, if we stop now, we lose everything we put in. The correct question is not, how much have we invested? The correct question is, given where we stand today, what is the best forward-looking decision? Corporate finance teams are trained to ask the second question. They treat historical spend as irrelevant to forward decisions. This is called sunk cost isolation. and it is a formal step in institutional capital allocation frameworks. Without that framework, your brain will make the wrong call every time. Trap 2 is more expensive than sunk cost because it doesn't just affect what you keep, it controls what you charge. Trap 2, loss aversion. In 1979, Daniel Kahneman and Amos Tversky published Prospect Theory. The finding: losing $500 feels approximately 2.5 times worse than gaining $500 feels good. That asymmetry is not a character flaw. It is how the human brain is wired. And in business, it produces one of the most financially destructive patterns: systematic underpricing. The rational case for a price increase is clear. Contribution margin is at 22%, below the 35% minimum needed to cover fixed costs and generate real profit. But raising prices means some clients might leave, and that loss, even a hypothetical one, registers as 2.5 times more painful than the margin gain. So the price doesn't go up. The margin stays at 22%. The business funds its overhead at the edge of viability. In one case I reviewed, a consulting firm had not raised its rates in 34 months. During that period, inflation had risen 11.2%. The real price of every engagement had declined by 11.2%, without a single client negotiating it down. Loss aversion did that silently. The corporate world neutralizes this through a margin floor mandate, a rule that states if a product or service does not meet minimum contribution margin, it gets repriced or discontinued. The mandate removes the emotional calculation from the equation. Trap 3 shows up in the quarterly projections. Every quarter, wrong, in the same direction. Trap 3, overconfidence bias. In 1977, a study asked drivers to rate their skill relative to other drivers. 93% rated themselves above average. In behavioral finance, this is called overconfidence bias. In business, it has one specific, expensive manifestation: revenue projections. Every small business revenue projection I reviewed over 10 years of financial analysis shared one statistical property. They were optimistic, not sometimes, every time, by an average of 34% in year 1, 28% in year 2. The founder projected best-case conversion rates, best-case close rates, best-case client retention. The market delivered median outcomes. The cash model was built on best-case assumptions. That gap between best-case projections and median reality is where working capital disappears. Corporate financial models use a technique called base rate anchoring. Before any projection is built, it is anchored to the historical median performance for that industry, that revenue stage, that market. The optimism is constrained by data. If the business is only viable at peak performance, the model is broken before operations begin. Trap 4 happens after the good month. This is when it gets expensive. Trap 4, availability heuristic. The brain assigns probability based on how easily an example comes to mind. After a strong sales month, a founder overestimates the probability that strong months are the baseline. After a weak month, they underestimate whether the business is structurally sound. Neither assessment is data. Both are the most recent available emotional memory, overriding the trend line. In October 2021, a retail business in Dallas posted its best month ever: $217,000 in revenue. The owner hired 2 staff members, signed additional warehouse space, and placed a $140,000 inventory order. The following 3 months averaged $83,000. The inventory sat. The lease payments didn't. The $217,000 month was real. The decision to treat it as the new baseline was not. Corporate finance teams neutralize this through rolling 12-month averages. No single month drives a capital allocation decision. The trend, not the peak, is the input. Trap 5 is the one hiding inside every financial review you've ever done on your own business. Trap 5, confirmation bias. The brain actively seeks information that confirms what it already believes and actively discounts what challenges it. In business, this is how a bad client stays on the books for 14 months. It is how a product at 9% contribution margin gets defended through 3 consecutive quarterly reviews. It is how a founder opens a financial report and finds the 3 numbers that support the thesis and glosses past the 6 that don't. I reviewed a case where the cash flow statement was clearly showing a DSO problem, 67 days and climbing. The founder opened the report, looked at the revenue line, and said, "Good month." The revenue line was fine. The DSO line was a 6-month early warning of a cash crisis. The crisis arrived on schedule, not because the data wasn't there, because the brain filtered it out. Corporate risk management uses adversarial review protocols. A second analyst whose explicit mandate is to find what the first analyst missed, not to validate, not to encourage, to find the DSO problem, the cost that didn't make the projection, the concentration risk sitting at 48% of revenue, 5 traps, all measurable, all preventable. The corporate world built a framework to neutralize every single one. That framework has never been translated for small business. Until now. The 5 traps I mentioned are not secret. They are covered in every behavioral finance module in every MBA program. What is not covered, what institutional teams learned through practice, not theory, is how to neutralize them systematically. Here is what the decision architecture actually looks like inside corporate. Mechanism 1. The pre-mortem developed by cognitive psychologist Gary Klein in the 1990s, formalized inside corporate risk management through behavioral economics research at Harvard Business School. Before a major decision is executed, the team assumes it has already failed, not might fail, already failed. The question then asked, why did it fail? That inversion removes 3 biases simultaneously. Overconfidence, because success is not assumed. Confirmation bias, because the team is actively looking for failure modes, not confirming the thesis. Loss aversion, because the failure scenario is acknowledged before the decision. A 2019 Harvard Business Review study found that pre-mortem analysis reduced strategic decision errors by 28 to 36% in organizational contexts. Most small business owners do a post-mortem, after the money is already gone. Mechanism 2. The margin floor mandate. This is a rule, not an analysis. Every product or service must meet a minimum contribution margin threshold. If it doesn't, the decision to reprice or exit is automatic, not subject to emotional override, not subject to client relationship politics, not subject to sunk cost pressure. The rule was made when the numbers were calm. It makes the decision when they are not. That separation between calm rule-making and high-pressure execution is the entire point. Mechanism 3. Base rate anchoring. Before any projection is built, anchor it to the industry median, not the best quarter, the median quarter. If the business model is viable at median performance, proceed. If it only works at peak performance, the model requires restructuring before capital is deployed. This one correction, from optimistic projection to median anchoring, would have prevented 34% of the small business failures I analyzed during a 3-year corporate restructuring engagement. One cognitive correction, 34%. Mechanism 4. Adversarial review. Do not review your own numbers alone. Assign a second reviewer with an explicit mandate. Find what was missed, not to validate, to challenge. The DSO problem, the cost outside the projection, the concentration risk being called a strong relationship. In a small business context, a bookkeeper with analytical authority, a CPA with a mandate to deliver uncomfortable findings, or a business partner whose explicit quarterly role is to find the holes. It is not optional if you want to make decisions the way institutional finance teams make them. 4 mechanisms. Each one neutralizes a specific cognitive trap. The next section shows you exactly how to build this into your business this week. This is not theory. This is a 5-rule decision architecture, a set of conditions that run before any capital allocation decision in your business. And if you are still employed and building toward your exit, these are the rules to install before you hand in your notice. Not the product, not the brand, the decision system. Rule 1. The 48-hour cooling period. No capital decision over $10,000 gets made on the day the idea surfaces. 48 hours, minimum. During that window, the emotional response, the excitement, the fear of missing out, the availability bias from last month's strong performance, has time to dissipate. The financial analysis remains. The emotion doesn't. You make the decision with the analysis, not the emotion. Rule 2. The adversarial framing test. Before any major pricing, hiring, or investment decision, ask one question. What would have to be true for this to be the worst decision I make this year? Write the answer down. If you cannot generate at least 3 credible failure scenarios, you have not stress-tested the decision. You have confirmed it. The adversarial framing test forces the brain from confirmation mode into pre-mortem mode in under 5 minutes. Rule 3. The contribution margin gate. Before adding any new product, service, or client engagement, calculate the contribution margin. Contribution margin equals revenue minus variable costs, expressed as a percentage of revenue. If it is below 35%, or your established floor, the engagement does not proceed at the proposed price. Reprice it or decline it. This is not a judgment about the client. It is a gate, and the gate protects the cash position that loss aversion would otherwise erode. Rule 4. The rolling 12-month revenue test. Never make a capital allocation decision based on a single month's revenue. Calculate the rolling 12-month average. The rolling average eliminates the availability heuristic. It eliminates the emotional weight of the peak month. It shows you the trend. The trend is the business. The month is an anecdote. Rule 5. The concentration ceiling. No single client represents more than 25% of total revenue. When a client approaches that threshold, the growth objective shifts, not to deepen that relationship, but to grow other revenue faster. This is not a growth strategy. It is a risk management protocol. The business running 40% of its revenue through one client is not a business. It is a subcontractor with branding. Here is what every business I mention had in common. The founder was not irrational. They were not undisciplined. They were not incapable. They were unprotected. They made decisions through a brain designed for survival, not for cash flow management, not for margin analysis, not for evaluating whether a sunk cost should override a forward-looking financial model. The corporate world spent decades building systems to protect decision-makers from their own psychology. The small business world has had none of that infrastructure. The employed dreamer building toward their exit has had none of it either. Good decisions do not require superior intelligence. They require a framework built before the pressure arrives. Next video.